10 a.m. It's Trevor Garvin here. I'm head of Nedgroup Investments multi-manager, and I will be chairing this morning's session. So today we are going to focus on the topic of behavioral finance, and specifically on how one can assist one's clients as a financial advisor to stick to their long-term financial plan through times of market stresses. Generally, clients show a degree of fear and anxiety, and as a fund manager, we are often at the cold face, I think, of experiencing the daily inflows and outflows during periods of market volatility from our funds. And over the last 23 years that I've been overseeing and managing funds and fund of funds, I continually really see how investors in times of market volatility and stresses at some point submit to their levels of anxiety and end up selling their investments right near the bottom of the market, and then generally buy back in right after the markets have retraced many of their losses. And of course, this is really not the ideal behavior, and it has a material detrimental effect on the investors' long-term returns, as they are buying in when things are expensive and they're selling when things are cheap. So one of the most important roles we feel as a financial advisor is for you to manage your clients' emotions during times of market stress. And this is very often best done right at the outset when agreeing the initial investment plan with one's client, and you're really trying to set the path ahead, educating the client that markets go through investment cycles, they go through declines, they go through rises, and also setting their expectations, I think, on things like what amount of capital losses they may face during these market cycles, and agreeing with them that ideally they can sit through that pain during times of market stress. So today, my colleague in the multi-manager team, Seugnet de Villiers, who has done much research over the years on this particular topic, she's going to present really some of her ideas and concepts on these matters that I've touched on. And we hope that we will be able to give you some tools to be able to do this with your clients. Our experience teaches us that the more simple you try and keep the message, ideally with some nice visual graphs to assist you, the easier it often is to educate your client right from that outset. So we hope that you find this useful. Seugnet will present for approximately 20 to 25 minutes, whereafter I will ask her a few follow-up questions before we wrap it up. So we expect that this session will take about half an hour or so. So without any further delay, I hand over to you, Seugnet.
Thanks, Trevor, and good morning, everyone. Thanks for your time to listen to our session this morning. I think before we can start looking at how to guide clients' emotions and how to help them manage it, it's always important to just have a clear understanding of exactly where they are in their investment journey and how they got there. Now, unfortunately, it's been a difficult few years for South African investors. The domestic economy has been struggling. We have had weak GDP growth. Our government debt has risen to unsustainable levels. The state-owned enterprises continue to struggle and add more pressure to the government's debt, and our unemployment rate has remained quite high. Now, even though a lot of the companies that form part of the all-share index are very globalized, in other words, they earn a large portion, or in some cases, even all of their revenue outside of the country, the weak domestic conditions has simply been too overwhelming for the domestic equity market as an asset class to deliver good growth. And then, of course, end of February, beginning of March, the coronavirus was labeled a global pandemic as opposed to limited to China, and we saw equity markets around the world plummet the fastest it ever has. So if you look at this chart, which shows you the cumulative growth of the all-share index over the last 6 years, you'll see that at the bottom of this year's performance on the 19th of March, there was literally a 6-year period over which the domestic equity market has delivered 0% growth. And this is nominal. This isn't 0% real. This is just 0% growth from the domestic equity market. And of course, the domestic equity as an asset class is quite an important building block of many domestic multi-asset funds, especially in the medium and high equity space. And then, of course, clients that hold pure equity funds have been fully exposed to this weak growth that we've had from the domestic market. So if you look at the last 3 and 5 year performance of the average categories from the low equity, medium and high equity space, as well as the pure equity, you'll see that these funds haven't been able to keep up with inflation, let alone outperform the inflation plus targets. It's really been a difficult environment for these types of funds, and many clients have some exposure, or in many instances, almost all of their assets invested in these types of portfolios. Now, the multi-asset income space, on the other hand, which is limited to 10% equity and predominantly consists of short-term bonds and cash instruments, has performed well. And by well, I mean it's delivered cash plus 1% to cash plus 2%, which it aims to do. And in the specific 3 to 5 year period, this 7% per annum is looking very attractive. Now, if you look at the emotional roller coaster of investors and how they behave and think through market volatility, it's really completely understandable that clients are now sitting at this bottom point where they're thinking, I told you so, it was a bad idea to invest in anything with exposure to the equity or property market, just get me to cash. You know, my friend is invested in an income fund and he's got this much performance, or the fixed rate bank deposit is delivering this great performance. We really are at the bottom, or very long into a cycle where growth assets just haven't delivered. Clients are panicking. They can no longer stomach seeing their hard-earned savings not perform or decline. And clients are now at the height of this feeling of, just get me out. I don't care what my initial plan was. I don't think this is a good idea anymore. So that's why it's so important for us as investment professionals to really step in now and help them manage this emotional reaction, because now is actually the worst time to switch. Like Trevor mentioned, this panic and this emotional side of investing often leads investors to sell at the bottom and buy at a high price, and we really have to step in and try and manage it. And we've clearly seen this behavior in the market. So what I show you on this slide here is, on the left, I've just taken various time periods, so 1, 3, 5, 7, and 10 and 15 years, and I added together the total net flows into the multi-asset income space and into the multi-asset high equity space. So dark green bars being the income space, light green bars in the high equity space. And here you can very clearly see how clients have been reacting or responding to the emotional element of investing, to the emotional element of markets delivering weak growth, and of course now extremely poor growth with the coronavirus crisis. And what I find fascinating on the left-hand chart is, if you look at the 3-year number, you'll see that the multi-asset income space has had a total inflow of 99 billion. Over 15 years, it's had a total inflow of 182 billion. In other words, more than half of the total flows that category has received over the last 15 years is from the last 3 years alone. And I really don't believe that this is because South Africans now have a much higher demand for short-term investments or a much higher demand for income needs. I firmly believe that what we're seeing in the industry is an emotional switch out of growth assets into something that's steady and consistent in the short term, but doesn't offer growth in the long term. And I mean, we have to appreciate clients' behavior. It's difficult to see your hard-earned savings decrease. It's difficult to maybe have 1, 2, or 3 annual reviews in a row where you keep hearing stick to the long-term investment fundamentals, things will change. Because for many clients, investments is a very complex topic. Market volatility is difficult to understand, and sifting through the daily news flow in terms of what's noise and what's fundamental is really difficult and close to impossible. So I want to run through a little exercise with you just to try and highlight in a simple way what actually happens in the human mind when faced with this complexity. So I'm going to ask you 3 questions. They're not trick questions. Just think of the answer where you are. My only rule is no outside assistance. So don't use a calculator, don't Google, don't phone a friend. Right, so the first question, what is 2 plus 2? My second question to you is, what is 62 plus 48? And then my last question, what is 32,765 plus 69,561? Now, my gut feel is that when I asked you what's 2 plus 2, you were able to, within a split second, just say it's 4. You just knew it's 4. Your mind didn't have to calculate it. You just knew. It was just in your memory. Similarly, when I asked 62 plus 48, your mind just knew that 6 plus 4 is 10 and 2 plus 8 is 10, and you put those together and it's 110. You didn't even have to think or switch to that side of your mind that needs to calculate. But when I asked you the last question, your reaction was most probably something along the lines of, whew, I don't know, or I can't do that without a calculator. You were a little bit overwhelmed and your mind most likely went blank for a split second or 2. And this reaction where, you kind of panic or you're overwhelmed or you think, oh, I can't do it, is a very dangerous reaction to investment decisions if it's not managed. So if you look at the third question again and you take a deep breath and you take a step back and you start calculating it step by step, you'll find a way to get to the answer without a calculator. It's completely possible. You just need to allow your mind to relax and get into a calculation and thinking mode. And the same is true for investment decisions in a world of complex news flow and market volatility. We need to get clients to not be overwhelmed by the complexity and go, oh, I can't even think about it. This is too complex. Just switch me to cash. And we need to get them in that frame of mind where they can calmly sit with you, go through the facts, ignore the noise, and get back to that space where they make their investment decisions on long-term fundamentals, as opposed to a state of being overwhelmed with complexity. So it's a silly little exercise, but it's quite a nice icebreaker or a way to just highlight to people, look, this is how you respond to complexity, but there's ways we can manage it. Just take a step back and relax, and let's go through the details step by step. And I find this can be quite useful to kind of set the scene for clients who are desperate to make a switch. And once you've kind of highlighted this to them and got them to that calm thinking space, then take them through a few good reasons to not switch out of their long-term investment plan to cash and rather stick to what you agreed at the outset. Now, my first pointer for having this conversation is firstly simply having a look at history. If we look at this chart, which shows the domestic equity market over the last 100-odd years, you'll see that we've been through bear markets before. We've experienced periods of high double-digit drops in the past, and the circumstances around each of these bear markets were very different. The drivers of each of these crises were very different, but the one common thread that you'll see on this chart is the fact that the market always recovers, and in fact, it always reaches new highs. So unfortunately, what we can't learn from history is when the current crisis will be solved, when we'll get back to the levels we were before the crisis. But the one thing we can learn from history and that clients can take comfort from is the current situation that we're in. Something similar has happened before. The market got out of it, and the markets continue to deliver to new highs. And then the very dangerous part about this recovery is just how quick and how unexpected it is, and almost always is. And March and April this year has actually given us the perfect example again. So March, up until the 24th of March, was one of the worst months that the domestic unit trust funds had, because markets globally had one of the worst months it's ever had. You know, the coronavirus just broke out. There was much uncertainty in the market. Countries were going into lockdown. And then, without any fundamental change in the details or the outlook around the coronavirus, April continued to be one of the best months ever. What I actually found interesting is, if you look at the dates I've used here, you'll see that the 1 month ending 24th of April delivered exceptionally good returns, but this month actually was started when South Africa went into national level 5 lockdown. So it's, you know, the market doesn't always make sense. It recovers quickly and unexpectedly when it almost fundamentally doesn't make sense. Our economy shut down with limited businesses open, yet the domestic equity market started running. And I've taken an extreme example of an investor that was very unlucky with his or her timing, but the reality is this actually isn't that extreme or far off reality, because I think many clients responded like this. So what I've done on this chart is I've said, let's assume a client had 100,000 Rand on the 24th of February, and he was invested in the equity market. That was his investment plan. He has a long-term horizon, and he's saving. He needs capital growth. Now, then the market started falling a little bit. There were 1 or 2 positive days. It was a little bit sideways, and then it fell a bit more. And on that journey, the client was thinking, oh, it's okay, the market will turn again, and change into that mode of, I can't disinvest now, I've lost too much money. And then often, like Trevor mentioned, at the height of the volatility, when the market's at its low point, is often when the client emotionally decides, I can't take this anymore, disinvest. And what I've done here is I've said, let's assume on the 24th of March, the client switched out of the equity market and said, just put me in cash. It's nice and steady and predictable. I can't take it anymore. And then all of a sudden markets turned. And here you can see that if he stuck to his initial plan, he would, on the 24th of April, have had 90,000 Rand, which is a 10% decline. But because he switched out of equity and sat in cash instead, waiting for a sign for the market to turn, he's actually down 25% off his initial value at 75,000 Rand. So in this very short-term example, this investor lost 15% because he deviated from his long-term investment plan and caved into the temptation of switching to cash. So it really can be very costly in the long term to react to the short-term emotion, the short-term volatility. And then just another chart that I think follows on quite nicely from this is just the long-term growth potential of cash. Cash offers a very nice and steady performance in the short term, and currently it's very attractive because we've gone through a weak investment cycle. But for a client that has a long-term horizon, relative to inflation, money market simply does not offer the growth that you need. So what I show you here is just the very long-term performance of the average money market fund versus the average multi-asset high equity fund relative to inflation. Here you can clearly see how nice and steady the money market performance is. It ticks up month after month. There's no surprises. Multi-asset high equity on the other side has a lot more volatility. There's ups, there's downs, there's sideways movements. But over the long term, it's delivered 5.3% per annum in excess of domestic inflation over this time period, and it's outperformed money market by 2%. Now, 2% maybe doesn't sound that much, but in Rand value terms, the 100 Rand that this client invested 20 odd years ago is now literally worth more than double that of the money market. So the power of compounding can really have a material impact on something that offers growth if you can just get your client to sit through the short-term volatility. Money market is suitable for specific clients with specific needs. Similarly, there are many clients who need exposure to the income funds, but for clients that need growth over the long term, that have a long-term investment horizon, money market simply doesn't offer anywhere near what a fund with growth exposure can offer. And then this probably sounds a little bit cliche, but it really is about time in the market as opposed to timing in the market. I just showed you how dangerous it can be to try and time the market. And now I want to show you the value of just sitting in the market for the appropriate time period. So what I've done here is I've looked at the various ASISA categories, being multi-asset income, low equity, high equity, and pure equity. And I've compared how often the average of these categories outperform the money market category over a rolling 1, 3, 5, and 10-year period. And there you'll see income is nice and steady and has a pretty good hit rate from the beginning, 75% over a 1-year period, 100% over a 10-year period. If you move to the higher risk funds like low equity, multi-asset, etc., you'll see that over a 1 and 3-year period, you actually only have a likelihood of outperforming money market of 60%, which isn't that high, but it's the price we pay to be able to achieve the growth in the long term. If you then increase your time frame to a 5-year period, those numbers already are quite attractive at 75 to 80%. And if you then stay invested for a 10-year period, the likelihood of these funds with growth exposure outperforming money market becomes effectively 100%. And then the very important thing to take that goes with this is how much these funds can outperform, by how much these funds can outperform. And that's what I show you in the bottom chart. I show you the average alpha over the various time periods over the last 20 years. And here I want to just highlight the fact that for the multi-asset income space, whether you invested for 1 year, 3 year, 5 year, or 10 year, the outperformance you can expect from that type of fund is 1 to 2% over and above cash. That's what those funds are designed to do. As you increase your risk exposure, in other words, as you increase your exposure to growth assets like equity and property, your potential alpha over cash increases, with your low equity space averaging 2% per annum, your high equity space averaging around 4%, and your pure equity funds offering around 6% per annum potential alpha. Now, another chart that's very important to go with these is just what happens around the average. What's the journey the client needs to be able to sit through to achieve this average? And here I try and illustrate exactly what volatility means. So on the very far left, you'll see the worst and best alpha or outperformance that each of these categories has achieved over a rolling 1 year period over the last 20 years. In other words, over the last 20 years, there's been a 1 year period at a month end where the multi-asset high equity space underperformed cash by as much as 25%. And there's also been a 1 year period where it's outperformed by as much as 50%. And this wide range of potential outcomes is exactly why these funds aren't suitable for the short term. It's just how equity and property and these growth assets behave. It's volatile and not suitable for a short-term investor. As you increase your time frame, you'll see how that range decreases all the way up to a 10-year period where it becomes more predictable. It's a narrower range of outcomes. And over a 10-year period, your potential outperformance is either in line with money market worst case or up to 10, 12% with an average of 6% in the equity space, like I just said. And I think these two slides combined is a really nice way to explain to clients why it's important to stay invested for the long term, what you may need to sit through in the short term, and how the income type funds compare to funds with more growth exposure. It really is a trade-off between time and risk and return. The more return you want to achieve, the more risk you have to take and the longer you have to remain invested, and vice versa. The shorter you can stay invested, the less risk you need to accept, and then you have to lower your return expectations. And then the next thing, or the last section I want to look at, is just what's called the availability bias. And this bias is currently quite present, I think, in clients' investment decision making. And what this effectively just means is the mind takes a shortcut to make decisions where it bases a decision on something that's recent or memorable. In other words, your mind subconsciously assumes that because I remembered it quickly, it must be important and therefore I must base my decision on it. But things that are very recent, so something you read this morning, or things that are very traumatic, are usually the things that come to mind first, but it's not necessarily the full set of information you need to base your decision on. And I'm just going to take you through an example of what's currently going on in the market. So if clients look at the rolling 1-year return of equity versus cash over the last 5 years, it's recent and traumatic. And you're going to look at this hit rate and say, equity has only outperformed cash 43% of the time. I don't like that type of investment. I'm not interested. I want to invest in cash instead. However, if you stretch the information that they use to make the decisions to the long term, to include the right timeframes, etc., you'll see that over a rolling 7-year period, which is a suitable timeframe for equity, the equity market has actually outperformed cash 99% of the time over the last 20 years. In fact, March 2020 was the first month in the last 20 years that the all-share index had a 7-year performance below that of cash. And based on this, equity is still a good investment option. Short-term market volatility and a market crisis doesn't change the long-term fundamentals of the asset class. And just to make it a bit more real for clients, because equity and cash has had this kind of performance relative to each other over the last 5 years, multi-asset income funds look much more attractive than multi-asset high equity funds over the last 5 years. In fact, multi-asset high equity has a very low hit rate of 20% over the last 5 years relative to income. But again, if we stretch the time frame to the appropriate period for high equity, which is 5 years, and we look at a full investment cycle of 20 years, your likelihood of outperforming income is actually quite high at 76%. And again, what's very clear on this chart is the extent to which multi-asset high equity can outperform an income type fund is much greater than the level of underperformance it has delivered in the past. So just to end off with my section, the question we are getting a lot from clients and advisors now is, what do we do? And we firmly believe that we still have to keep doing what we've always been doing. The way you construct portfolios today should still be the same you constructed portfolios 3 years ago, 5 years ago, etc. I've listed a few points for you here that I think is very important. Firstly, your time frame, like I said, is still the key driver of the level of risk you can afford. Like I showed you in the equity outperformance versus money market in the short term, equity simply isn't a suitable solution for a 1-year horizon. You need time to be able to invest in equity. Your risk tolerance is a very important driver of your asset allocation in terms of how much equity versus cash versus bonds you can have. And this asset allocation then drives your expected return. I'm going to pause at this point and just hand back to Trevor and see if there's any questions.
Great. Thanks, Sunay. Some nice, very nice slides there, I must say. Well done. I've just got a couple of questions here that we can perhaps just address before we wrap up. So just the one question, and I also get asked it quite often when on the road seeing advisors, is have you done any research on clients who are having living annuities? So of course, from these living annuities, people are taking a monthly income. And when we have periods like March, where there's large market drawdowns, this can of course put their income under pressure, and many clients put pressure on their advisors to increase their annuity income percentage amount so that they can keep their income on a constant level. So just could you perhaps comment on that? I mean, what should clients be doing when with living annuities, when there are these market drawdowns in terms of their income and the percentage that they're taking?
Sure. That's always such a difficult question, because I mean, I feel for the retirees drawing an income being exposed to the current market conditions. And unfortunately, there isn't a quick and easy fix. There's nothing you can do to reverse the current conditions and what's happened to the portfolio. The only two things that you really can do is, firstly, stick to the basic, stick to your investment portfolio. It is so important that a client in the living annuity space captures the full recovery, because that's the only way that they're going to get back to a level where they were before. Because locking in a loss like we saw now, for example, 15%, can have a material impact on either how long their money will last or on the living expenses they will be able to draw in the future. So it's really so important for the living annuity clients to just stay invested in their current portfolio. They need to remain exposed to growth assets to try and recover. And then, of course, where possible, just try and reduce the income rather than increasing the drawdown to get back to the same absolute value. Cut as many expenses as you can as possible, because I think the more capital that you can leave to grow and leave to be exposed to the market, the better. And that's really the only two things that living annuity clients can really do. Just stick to the plan and where possible, try and reduce the income drawn.
All right, great. Yeah, that makes sense. And just perhaps final question is, we talk about asset classes and diversification, and some of the examples that you used in your slides were talking to the multi-asset type of funds, which is where we've certainly seen the vast majority of flows going into the last 5 years or so. So where we're having these multi-asset funds and we're investing across the different asset classes, I mean, one of the areas that we can diversify is not only the asset classes, but also domestic versus global, across domestic asset classes and global asset classes. Can you perhaps just give some comment to advisors on how to tackle conversations with clients in terms of how much domestic versus offshore assets to perhaps put in an average client's sort of medium balanced risk type portfolio? Do you have any views on that?
Sure. So, I mean, in many portfolios, regulation will drive that. If a fund is regulation 28, needs to be regulation 28 compliant, that'll be limited to 30%. But we've just seen again now in the current crisis, the value of having exposure to offshore assets, because you have two markets effectively that can behave different to your domestic markets. So the global equity market can deliver different performance, and the currency can also deliver different performance. And what's happened year to date is your global equity markets performed as poorly as your domestic equity markets, but because the rand weakened by so much, as a South African rand investor, your exposure to global assets were actually neutral to marginally up. So again, that's just a very good example of how diversification works. I mean, it's all about exposing yourself to things that react differently to the same condition. So that's a very, including offshore, definitely has a major benefit, because either global equity markets or global bond markets can perform differently, or the currency can perform differently. The one thing that I just always, let's say, warn against is just the awareness of currency. And I find clients often behave towards currency the same way they behave towards the panic of markets having fallen. Often when the rand has shot out to 18 rand or 20 rand, it's often then when clients think, oh, South Africa is a bad investment place, I need offshore exposure, and then often they invest at a weak rand or at a expensive level. So I think having offshore is definitely a very valuable part of the asset allocation, but one just needs to manage your currency exposure. It's just be aware when you buy offshore and when you sell offshore that you don't end up buying expensive dollars and selling it at a lower price.
Yep, I think that's totally correct. And yeah, I mean, we saw that playing out perfectly about 10 years ago when the rand weakened considerably and then came all the way back, I think from sort of 18 rand to the dollar back to 11 rand to the dollar, and it took clients years to make that up. Seugnet, thank you. I think we're out of time. Our timing has been perfect, so thanks so much for that. And I'd like to thank everybody else who's dialed in. It's hopefully you found it interesting and worthwhile. And I think really the major part of the message we're trying to just make is the role that is so critical for financial advisors in managing your clients' emotions through the market cycles, because it can have a major positive effect on clients' end of day returns that they achieve across their portfolios. And of course, that's going to make their retirement and lifestyle completely, hopefully more manageable if they are investing correctly and appropriately. So thanks for that, everybody. Please just watch your email space going forward for next week. There will be more Nedgroup Investment Insights at 10 a.m. happening with the speakers communicated. So please watch out for that space. I know that the sales team have got some interesting guys possibly lined up over the next couple of weeks. So thank you, everybody, for dialing in again. Please have a lovely weekend, relax a little bit, stay safe and healthy, and we shall no doubt speak again in the coming weeks. Thanks, everybody. Cheerio.
Bye.